So, imagine for a second that you've spent, your entire adult life carefully building up this retirement nest egg.
Right, doing everything by the book.
Exactly. You've maxed out your contributions, you've navigated all the market crashes, and you're playing the long game. And then you reach your 70s, ready to finally just let that capital serve as a permanent safety net.
Time to relax, right?
You'd think so. But there is this specific non-negotiable clause in the tax code that just fundamentally alters your relationship with your own money. It's a rule that literally forces you, mathematically, to start draining those accounts.
Yeah. And it doesn't care at all about your personal cash flow needs.
Right. And if you ignore this requirement or even just, miscalculate the actuarial math behind it, you trigger what has to be one of the most punitive tax penalties in the entire federal system.
It really is. It's the moment the government essentially calls in a multi-decade marker.
Yeah.
Because you've been operating in this heavily subsidized, tax-advantaged environment for, 30 or 40 years? And this is the mechanism that finally ends the subsidy.
So today, our mission for this deep dive is to completely decode this complex and frankly kind of unforgiving world of required minimum distributions, or RMDs.
It's a crucial topic.
It really is. We are going to unpack this incredibly detailed Investopedia guide on the topic, looking at the underlying economic philosophy of why these forced distributions even exist, the constantly moving legislative targets of when they hit, and the specific math used to calculate the withdrawals.
And we definitely need to get into how the entire landscape flips on its head if you happen to inherit one of these accounts.
Oh, absolutely. The overarching goal here is to equip you, the listener, with the strategic framework you need to protect your savings from just completely unnecessary tax penalties.
Yeah, because we really need to start with a fundamental reframing of how we view pre-tax retirement accounts. I mean, there's this huge tendency to look at a 401k or a traditional IRA balance and think of it as entirely yours.
Because it has your name on it.
Exactly. But if we look at the macroeconomic design of these vehicles, an RMD represents the final phase of a very specific long-term contract that you signed with the Treasury Department.
Let's explore that contract, because on the surface, forced withdrawals just feel, they feel contradictory to everything we are taught about financial planning,
They do. Save, compound, hold.
Right. We are told to save and hold. Then suddenly, the IRS mandates a withdrawal phase. So what actually was the original deal we made back in our 20s or 30s?
The deal is built entirely around deferred tax liability. Like when you funnel money into a traditional 401k during your prime earning years, the government grants you a massive immediate concession. You don't pay ordinary income tax on those dollars.
Which is a huge benefit on the front end.
Huge. And furthermore, they allow that capital to compound without dragging down your annual returns with, capital gains taxes or dividend taxes every year.
Right.
But, and this is the key, the Treasury wasn't offering permanent tax amnesty. They were offering a deferral. So the RMD is simply the enforcement mechanism to ensure that eventually that tax shelter dissolves, the money enters your taxable income stream, and the government finally collects its deferred revenue before you pass away.
I look at it a bit like a highly subsidized commercial storage unit. Like the government allowed you to rent this massive secure facility for your capital at an unbelievable discount for 3 or 4 decades.
That's a really good way to look at it.
Right. You've been packing this unit full of equities and bonds, just enjoying the climate control. But the structural catch in the rental agreement, the fine print you didn't really read when you were young, was that at a specific date, the landlord gets to roll up the door and demand a percentage of the total value of whatever you've stored inside.
Yeah, you simply cannot leave the capital in the unit forever with the door locked.
Exactly. The lights have to come on eventually.
That analogy captures the essence perfectly because it highlights the liability aspect. I mean, the phrase deferred tax liability isn't just some dry accounting term. It is a literal debt.
A debt that comes due.
Yes.
Yeah.
The IRS imposes these RMDs as a targeted safeguard against wealth hoarding. Because if you think about the incentives, without an RMD, high net worth individuals who don't actually need their retirement savings to buy groceries or pay the electric bill, they would just leave the capital in those tax-advantaged accounts permanently.
Because why wouldn't you?
Exactly. It would become this generational, tax-free, compounding fortress. So the RMD deliberately breaches that fortress, forcing the money out of the shelter and into the taxable open air.
Yet there is this fascinating disconnect in the source material regarding who this rule actually impacts. If we look at the broader retirement landscape, most retirees aren't hoarding their capital.
No, Dago.
They are actively drawing down their 401ks and IRAs well before their mid-70s just to cover, medical expenses, property taxes, daily living.
And that is the core irony of the whole policy. For a huge swath of the demographic, the RMD mandate is completely invisible.
Because they're already pulling the money out.
Right. Like
Yeah.
if your required withdrawal is $15,000, but you are already pulling out $30,000 a year to live, you are satisfying the requirement organically. You don't even have to think about it.
Well, that makes sense.
The regulatory machinery only truly bites the people who have the luxury of not needing their funds. It's an anti-hoarding measure aimed squarely at folks with sufficient external income, like pensions, real estate, taxable brokerage accounts, who would otherwise just use the IRA purely as a permanent tax avoidance vehicle.
This brings us to the actual timeline. Knowing that the IRS uses this tool to eventually tax the shelter, the immediate question for the listener is the trigger date. When does the clock run out?
Well, currently, the mandate kicks in by April 1st of the year after you turn 73.
73. Okay, but the guide makes a huge point of this. That number requires a massive asterisk, right?
A gigantic asterisk. Because it's a prime example of how legislative shifts just completely complicate long-term planning. Prior to the year 2023, the age was 72.
Right.
And before the Secure Act of 2019, the trigger age was 70 and a half.
I find this shifting goalpost incredibly problematic for serious financial modeling. I mean, imagine you build a comprehensive Monte Carlo simulation when you're 55, structuring your entire drawdown strategy around age 70 and a half.
Right, which was the rule for decades.
Yeah, and by the time you actually leave the workforce, Congress has just altered the foundational math. So what is the macroeconomic incentive for them to keep pushing this age backward? Delaying the RMD means delaying tax revenue, which seems totally counterintuitive for a government running a massive deficit.
It is a really delicate balancing act. There are two primary forces pushing that age back. First, you have the actuarial reality of changing life expectancies. Over the last few decades, life expectancy for affluent individuals, who are the ones most likely to have substantial retirement accounts, has increased.
So they're living longer, so the money needs to last longer.
Exactly. The actuarial tables need to reflect a longer lifespan to ensure the accounts aren't drained prematurely. But the second, maybe more cynical driver is just legislative maneuvering.
Politics.
Always politics. Pushing the age back to 73 and eventually to 75 under the Secure 2.0 Act is highly popular with voters. It gives investors more flexibility and a longer runway for tax-deferred compounding.
Everyone loves a tax break.
Right. However, to your point about the deficit, Congress doesn't just give away revenue. As we'll discuss when we get to inherited accounts later, they offset the cost of delaying these RMDs by drastically increasing the tax burden on the heirs who inherit these accounts.
Oh, wow. So it was a calculated revenue swap.
Precisely. A total shell game.
So the cost of missing this moving target, whether through, just ignorance of the new legislation or a simple math error, it's uniquely severe. The guide points out we are talking about the IRS levying a 25% penalty tax on the unwithdrawn amount.
Which is, amazingly, a recent legislative mercy.
Wait, a mercy?
Yeah, prior to Secure 2.0, that penalty was a staggering 50%.
50% of the required distribution.
Yes. So if your calculated RMD was $40,000 and you failed to take it, the baseline penalty was $20,000.
Gone.
Simply evaporated. And that is a crucial distinction to make. It is not a 25% tax rate. It is a 25% penalty on top of the ordinary income tax you still owe when you eventually withdraw the money.
That is brutal.
It acts as an absolute sledgehammer designed to enforce compliance.
Yeah.
The IRS does not want to audit millions of individual retirement accounts, right?
Yeah.
They want the threat of the penalty to be so draconian that brokerages and taxpayers just police themselves perfectly.
I mean, the reduction to 25%, and the guide says it can even drop to 10% if the error is corrected within a 2-year window. That suggests the IRS realized a 50% penalty was almost too brutal to enforce practically.
Oh, absolutely.
Yeah.
When the penalty is 50%, a CPA will fight tooth and nail to claim a waiver. They'll cite cognitive decline or a bank error or something, which just clogs up the IRS appeal system.
Right. Nobody's paying that without a fight.
Exactly.
Yeah.
Lowering it to 25%, and specifically 10% for swift self-correction. It incentivizes the taxpayer to simply admit the mistake, pay the fine, take the distribution, and move on. It streamlines the whole enforcement mechanism.
Just take the lesser blow.
Right. But regardless of the reduction, the underlying principle remains the exact same. The government does not view the RMD as an optional guideline. It is a strict mandate.
Okay, let's transition from the theory and the threats to the actual mechanics. How does the IRS calculate the speed at which you must drain your portfolio? Because it isn't a flat percentage rate.
And no, it's not. They use a specific three-step calculation that you must execute annually. Step 1 relies on a hard snapshot. You have to take your exact account balance as of December 31st of the previous year.
Okay, stop right there, because that snapshot is critical. It introduces a massive layer of market risk, specifically sequence of returns risk, into the equation.
Really does.
Like, if the market is at an absolute all-time high on December 31st, your required withdrawal amount for the next year is going to be locked in at a very high number.
Even if the market completely crashes in January.
Exactly. Even if your portfolio drops by 20% in the first week of the new year, you still owe the IRS an RMD based on that inflated December value.
Yes. You might be forced to liquidate significantly more shares of your portfolio than you anticipated just to satisfy a static dollar amount that was calculated during a market peak. It can really accelerate the depletion of your assets.
Okay, so that is step 1. Get the December 31st balance. Step 2, according to the text, involves matching your current age to a distribution factor found on the IRS Uniform Lifetime Table.
Which brings us to step 3.
Right, the division. You divide the December 31st balance by that distribution factor. And I want to spend some time on this factor because this is where the IRS actuarial science really dictates your financial life. Let's look at the Bob example from the guide.
Yes, Bob.
Right. So Bob is turning 74 this year. His previous December 31st balance was exactly $205,000. So Bob goes to the IRS table, and the factor for a 74-year-old is 25.5.
Okay, so you take the $205,000 divided by 25.5, and you get exactly $8,039.21.
Boom! That is Bob's minimum withdrawal to avoid the sledgehammer fine. But the key here is what happens to that factor over time. For a 73-year-old, the factor currently starts around 26.5. But as you age, that number progressively shrinks.
Yep. By age 90, the factor is down to 12.2. By age 100, it's 6.4.
The math here is kind of elegant from the Treasury's perspective, isn't it? Because you are dividing your total balance by a progressively smaller denominator. The mandated percentage of your portfolio that you must withdraw basically accelerates every single year.
Elegant is one word for it. Terrifying is another.
I visualize it kind of like squeezing a tube of toothpaste. When the tube is full, like when you're 73, you just squeeze a tiny bit. The IRS is only forcing you to withdraw about 3.7% of your portfolio. Your investments can easily out-earn that withdrawal rate, so your overall balance might actually continue to grow.
Right, the math is gentle at first.
But as you hit your mid-80s and the distribution factor drops, the tube gets emptier. The IRS math essentially forces you to squeeze out a larger and larger percentage of what's left. You are suddenly forced to withdraw 6%, 8%, 10% annually.
And at that point, the forced withdrawals drastically outpace any realistic market return. Your portfolio balance inevitably begins to hollow out.
It's engineered to do that.
Absolutely.
Yeah.
The math is intentionally designed to exhaust the tax-sheltered capital within your projected lifespan. They are methodically accelerating the tax realization. However, I should mention, the IRS does provide a narrow carve-out for a very specific marital dynamic.
Oh, right, the exception to the standard table.
Yes. If your sole primary beneficiary is your spouse, and your spouse is more than 10 years younger than you, the standard uniform lifetime table does not apply.
That seems like an oddly specific demographic to write a whole tax exception for.
It does, but it stems from the underlying purpose of the retirement account, which is to provide living expenses for the retiree and their spouse. Like, if a 75-year-old is married to a 60-year-old, using the standard table would force the 75-year-old to drain the account based on their own shorter life expectancy.
Which would leave the younger spouse with nothing.
Exactly. By the time the older spouse passes away, the account could be severely depleted, leaving the 60-year-old surviving spouse totally financially vulnerable for potentially decades. So the IRS allows this couple to use a different table, the joint life and last survivor expectancy table.
Which incorporates the much longer life expectancy of the younger spouse, resulting in a significantly larger distribution factor.
Correct. A larger denominator means a smaller required withdrawal. It slows down the toothpaste squeezing, preserving the capital in the tax-sheltered environment longer to ensure it can actually support the younger spouse through their entire natural life.
Okay, so this calculation, taking the balance and dividing by the factor, is theoretically simple in isolation. Bob has one account, he does the math, he's done.
If only it were that simple.
Right, because modern portfolio construction is rarely isolated. Over a 40-year career, an investor doesn't just have one clean account. They have an old 401k from a job in the 1990s, a rollover IRA at a major brokerage, maybe a SEP IRA from some independent consulting work.
It becomes an absolute soup of different account types and custodians.
Exactly. And navigating the RMD mandate across a fragmented portfolio like that introduces intense strategic complexity.
And this is exactly where passive investing must transition into active tax management. The first step in untangling that portfolio is segregating the pre-tax accounts from the after-tax accounts, because RMDs apply strictly to traditional pre-tax vehicles.
Right.
So traditional IRAs, 401k SEPs, and simple IRAs.
Right.
They do not apply to Roth IRAs or Roth 401ks during the original owner's lifetime.
Because Roth accounts are funded with capital that has already been subjected to ordinary income tax. The IRS already extracted their revenue on the front end before the money ever even entered the account.
Already got their cut.
Right. The structural agreement of a Roth is tax-free growth and tax-free distribution. The government has zero financial incentive to force a withdrawal because a withdrawal doesn't trigger a taxable event.
Exactly. So we surgically remove the Roth holdings from the RMD calculation entirely. You don't even look at them. The remaining pre-tax accounts are where the strategic maneuvers occur, specifically relying on what is known as the aggregation rule.
Okay, break that down for us because the guide highlights this as a major strategy.
Sure. So if an investor holds 3 separate traditional IRAs, perhaps one holds high-yield bonds, another holds volatile tech equities, and a third is primarily just cash equivalents, the IRS mandates that the RMD must be calculated for each account individually.
You can't just mash them together.
Right. You cannot simply look at the total aggregate balance of all 3 accounts at once.
So you run the formula 3 separate times. You determine that, say, IRA A requires a $10,000 withdrawal, IRA B requires $15,000, and IRA C requires $5,000.
Correct. So your total federal liability for the year is $30,000. But the aggregation rule dictates that you do not have to withdraw those specific amounts from those specific accounts. You can sum the total liability, the 30 grand, and execute the entire withdrawal from just one of those IRAs, or distribute it in whatever ratio you choose among them.
The strategic power of that rule is immense for portfolio rebalancing. Like, let's say IRA B is your equity growth engine, heavily weighted in an S&P 500 index fund, and the market is currently in a deep correction.
The last thing you want to do is sell equities at a 20% loss just to satisfy a tax mandate.
Exactly. The aggregation rule prevents you from being forced into that poor structural trade. Instead of selling those depressed equities in IRA B, you can aggregate the total $30,000 requirement and pull it entirely from IRA C, which we establish as holding cash or stable fixed income assets.
You satisfy the IRS's aggregate dollar requirement without disturbing your long-term equity positions during a market downturn.
It's brilliant.
It really is. It allows the retiree to essentially play the role of an active fund manager, utilizing the forced withdrawal to strategically prune the portfolio, eliminate underperforming assets, or shift overall asset allocation, all while remaining perfectly compliant with the IRS.
But the architecture of this rule is frustratingly inconsistent. It applies beautifully to a collection of IRAs. But if we introduce an employer-sponsored plan into the mix, say a 401k left over from a previous employer, the aggregation logic completely breaks down.
Oh, it falls apart completely. That is a critical trap for the unwary. You absolutely cannot aggregate a 401k RMD with an IRA RMD.
So they don't mix.
Not at all. If your 401k dictates a $12,000 withdrawal, that exact $12,000 must physically exit that specific 401k account. You cannot pull $12,000 extra from your IRA to cover it.
Why is it so disjointed?
Well, the rules governing employer-sponsored plans fall under ERISA, the Employee Retirement Income Security Act, which operates under an entirely different regulatory framework than individual IRAs. Each 401k is basically its own walled garden.
Wow. So if you have 3 different 401ks from 3 different former employers,
You must take 3 distinct separate distributions, one from each.
that seems like a nightmare to manage.
It is. This lack of flexibility is actually a massive argument for consolidating old employer plans into a single rollover IRA before you reach age 73, purely to unlock the power of the aggregation rule.
Get everything under one roof so you can actually control where the distributions come from.
Exactly.
Okay, so knowing the inflexibility of these structures, it leads directly to the search for exceptions. When a policy is this rigid, investors naturally look for the pressure release valves. Are there legal methodologies to delay the inevitable or at least, mitigate the collateral damage of these forced distributions?
There are a few, but they are incredibly specific. The primary pressure valve mentioned in the source is the still working exception, though its utility is highly circumscribed.
How so?
Well, if you are 75 years old and still actively employed, your current employer's 401k plan may allow you to defer your RMDs until the year you actually retire.
So the government acknowledges that if you are still earning a W-2 salary, you likely don't need to be forced to tap into your retirement reserves just yet.
In theory, yes.
Yeah.
But the guardrails on this exception are severe. First, it only applies to the specific 401k tied to your current active employer. It offers zero protection for your outside IRAs and zero protection for 401ks held at previous companies.
Oh, so those other accounts are still ticking time bombs.
Completely. Those are all fully subject to the standard age 73 mandate. And second, it contains an explicit anti-abuse provision. If you own more than 5% of the company you work for, the exception is void.
Ah, I see. Because without that 5% rule, every aging business owner would just keep themselves on the payroll indefinitely, drawing a nominal salary specifically to shield their massive 401k from required distributions.
Exactly. The IRS is willing to grant a deferral to a rank-and-file employee who chooses to work into their late 70s. They are absolutely not willing to grant an indefinite tax shelter to a majority shareholder.
Okay, but for the vast majority of retirees who are no longer working, there is no deferral. The distribution is happening. And this triggers what financial planners often call tax shock, which, and this is vital for the listener to understand, it isn't just about paying taxes on the RMD itself. It's about the collateral damage that forced income inflicts on the rest of your financial ecosystem.
Right, the progressive nature of the U.S. tax system turns the RMD into a total financial domino effect. Because forced distributions are categorized as ordinary income. They are stacked directly on top of your Social Security benefits, your pension payouts, your dividend yields, and your interest income.
Let's quantify that domino effect.
Yeah.
Let's say a retiree has a very carefully calibrated tax strategy. They're keeping their taxable income right at the top edge of the 12% marginal bracket. They are living comfortably, paying a historically low rate.
Sounds ideal.
Right. Then suddenly, age 73 hits, and the math forces a $60,000 RMD onto their ledger.
That 60 grand doesn't just get taxed at 12%. It fundamentally alters their entire tax profile. First, it thrusts them straight through the 12% bracket and deep into the 22% or 24% marginal tax brackets.
So their overall effective tax rate just skyrockets.
Exactly. But the collateral damage goes much deeper than marginal brackets.
Yeah.
We have to look at the taxation of Social Security.
Oh, this is a big one.
It is. If a retiree's income is low enough, their Social Security benefits are entirely tax-free. But as their provisional income rises, up to 85% of their Social Security benefits become subject to federal income tax.
Wait, so a large RMD can trigger that threshold?
Yes, meaning the forced withdrawal is actively causing a completely separate stream of income that was previously untaxed to suddenly become taxable.
The RMD essentially acts as a contagion, spreading tax liability to previously protected assets.
That's a perfect word for it. Contagion. And it doesn't even stop at the IRS. It bleeds directly into healthcare costs.
Yes, Medicare premiums. The guide explicitly mentions this. Medicare premiums are highly sensitive to income through a mechanism called IRMAA, the Income-Related Monthly Adjustment Amount.
Right. If that $60,000 RMD pushes your modified adjusted gross income over certain strict legislative thresholds, the government permanently increases your Medicare Part B and Part D premiums for the entire year.
It functions as a stealth tax.
Totally. You're paying more for the exact same healthcare coverage purely because the IRS forced you to liquidate part of your IRA.
This cascading series of financial penalties, higher marginal rates, taxed Social Security, inflated Medicare premiums, it really explains why high net worth investors deploy highly aggressive mitigation strategies long before they reach age 73.
They have to.
And one of the most effective tools for dismantling this tax bomb, which the source touches on, is the systematic Roth conversion.
The Roth conversion is essentially a controlled demolition of the deferred tax liability.
I love that phrase, controlled demolition.
It fits perfectly. Instead of waiting for the IRS to force a massive, highly disruptive RMD at age 73, an investor in their early 60s might deliberately withdraw a specific, manageable amount from their traditional IRA every single year.
And they pay the ordinary income tax on that amount immediately.
They do. They voluntarily trigger a taxable event.
But they do it on their own terms.
Exactly. They control the exact dollar amount to ensure it just fills up the lower tax brackets without spilling over into the higher ones or triggering those IRMAA surcharges we just talked about.
Hmm.
Once they pay that calculated tax toll, they immediately funnel the remaining capital into a Roth IRA.
So by doing this over a 10-year period, say, from age 63 to 73, they systematically drain the pre-tax accounts. They're shrinking the balance of the traditional IRA, which means when the age 73 RMD mandate finally hits, the denominator in that math equation we talked about is much smaller.
Right. The forced withdrawal is minimized, and the tax shock is totally neutralized. Furthermore, all that capital they move over is now sitting in a Roth IRA, compounding tax-free and completely immune to RMDs for the rest of their life.
It's brilliant. It requires paying taxes earlier than strictly necessary, but it provides absolute certainty. It removes the legislative risk of Congress raising tax brackets in the future, and it completely insulates the portfolio from the compounding pressure of forced actuarial distribution.
It's the ultimate defensive move.
But what if someone doesn't do that? If an investor reaches age 73 without doing these conversions, and they are facing these massive RMDs, they do have the legal right to just withdraw the entire balance at once, correct? The guide notes that the law mandates a minimum, but there is no maximum.
Legally, yes. You could take a $2 million traditional IRA and liquidate the entire position on your 74th birthday.
Just cash it all out.
You could, but mathematically it would be an act of total wealth destruction.
Because of the progressive bracket compression?
Exactly. If you spread $2 million of income over 20 years of RMDs, you are pulling $100,000 a year. You are staying in relatively moderate tax brackets, preserving the vast majority of the capital.
Right.
If you pull $2 million in a single calendar year, $1.4 million of that distribution is going to be taxed at the absolute highest federal marginal rate, currently 37%, plus whatever the top state income tax rate is in your jurisdiction.
Oh, man. In places like California or New York.
You could instantaneously incinerate 50% of the account value purely through an unforced tax error. The RMD structure enforces a slow drip, specifically because the progressive tax system violently punishes massive lump sum distributions.
Okay, so everything we have discussed so far applies to the original architect of the portfolio, the person who earned the money, deferred the taxes, and navigated the drawdown. But the structural complexity of these accounts magnifies exponentially when the original owner passes away.
That's a whole different ballgame.
The moment an IRA is inherited by the next generation, the entire regulatory landscape undergoes a seismic shift.
Inherited accounts really represent the most aggressive phase of the government's tax reclamation strategy. The IRS views the death of the original account owner as the ultimate deadline to close out the deferred tax liability.
The first major paradigm shift involves Roth accounts. We spent considerable time establishing that Roth IRAs are immune to RMDs because the taxes were paid up front. But that immunity is strictly a lifetime benefit. The moment a Roth IRA transfers to an heir, it becomes subject to forced distributions.
This is a profound misunderstanding among beneficiaries. I see it all the time. They inherit a Roth and assume it operates into the same permanent tax-free shelter their parents enjoyed.
Right, they think, oh, it's a Roth, I never have to touch it.
But the IRS logic is very clear. They agreed to waive the taxes on growth to incentivize the original worker to save for their own retirement. They never agreed to provide a permanent, multi-generational, tax-free compounding vehicle for the heirs.
So the heirs have to empty it.
Yes. The government still won't tax the withdrawals from an inherited Roth. That money is still tax-free. But they absolutely will force the heir to empty the account on a strict timeline, pushing that capital back into the broader taxable economy.
To understand the modern timeline of inheritance, we really have to examine what the guide positions as the single most disruptive piece of retirement legislation in modern history, the Secure Act of 2019.
Oh, absolutely.
This act drew a hard, permanent line in the sand regarding generational wealth transfer.
The dividing line is absolute. The regulatory treatment of an inherited IRA depends entirely on whether the original account owner passed away before midnight on December 31st, 2019, or after January 1st, 2020.
Let's look at the pre-2020 landscape first, because understanding what was lost really explains exactly why Congress intervened. Before the Secure Act, estate planners utilized a strategy known as the Stretch IRA.
The Stretch IRA was an incredibly elegant exploitation of actuarial math. Under the old rules, if an individual inherited a pre-tax IRA, they were allowed to calculate their forced RMDs using their own life expectancy on the IRS single life table.
Okay, let's play that out. So if a 75-year-old grandfather passed away in 2018 and left a $1 million IRA to his 22-year-old grandson.
Right. The required distributions weren't based on the grandfather's compressed timeline. They were based on the statistical probability that a 22-year-old would live another 60 years.
Oh, wow. So because the denominator in the RMD equation was so massive, a 60-year life expectancy, the required annual withdrawal was mathematically negligible.
Tiny. Perhaps 1 or 2% a year. The grandson would take out $15,000, pay a tiny amount of tax, and leave $985,000 in the account.
Mhm.
Over the next 12 months, the market growth of the account would vastly outpace that tiny distribution.
The account would just continue to grow, tax-deferred, for decades.
Exactly. The grandson could literally stretch the tax-sheltered status of his grandfather's original earnings across his own entire natural lifespan. It functioned as a self-perpetuating engine of dynastic wealth.
And that is precisely why Congress destroyed it. From a macroeconomic perspective, the stretch IRA was starving the Treasury of revenue.
Completely starting them.
The government was being forced to wait nearly a century to collect the final income tax on dollars that were originally earned and deferred in the 1980s. When Congress was looking for ways to fund the cost of pushing the standard RMD age back to 73, they realized they could generate massive revenue by accelerating the taxation on inherited wealth.
Thus, the Secure Act was born.
So the Secure Act fundamentally dismantled the stretch IRA by segmenting beneficiaries into highly specific, tightly regulated categories. Let's start with the most protected class, the eligible designated beneficiary.
This is a very narrow, strictly defined group. It primarily consists of the surviving spouse. It also includes minor children of the deceased, and importantly, only the direct children, not grandchildren, as well as individuals who are chronically ill, disabled, or beneficiaries who are not more than 10 years younger than the deceased account owner.
So if you fall into this elite category, you retain some of the old protections. A surviving spouse, for instance, can simply absorb the inherited IRA into their own name and treat it as if it were originally theirs, delaying RMDs until they hit age 73 themselves.
Yes, the eligible designated beneficiaries are granted a lot of operational flexibility, but they represent a fraction of inheritances. The vast majority of wealth transfer goes to adult children, nieces, nephews, or grandchildren.
And under the Secure Act, these individuals fall into the standard designated beneficiary category.
And for them, the legislative hammer has definitely dropped in the form of the 10-year rule.
The 10-year rule. This is huge. It essentially states that the actuarial tables no longer matter at all. Your life expectancy is irrelevant. You have exactly 10 calendar years following the year of the owner's death to completely liquidate every single penny inside the inherited IRA.
It is a brutal compression of the timeline. Going back to our previous example, instead of stretching that $1 million IRA over 60 years, the 22-year-old grandson now has 10 years to empty the account.
Wow.
And while he has the flexibility to withdraw it in equal installments over the decade, or leave it all in the account and take one massive lump sum distribution in year 10, the final result is inescapable. The tax shelter evaporates in a decade.
The tax implications for adult children inheriting these accounts are devastating. Typically, an individual inherits money from their parents when they are in their late 40s or 50s.
Which corresponds perfectly with their peak earning years.
Exactly. They are likely at the height of their career already sitting in a high marginal tax bracket. Suddenly, the IRS forces them to pull massive amounts of ordinary income out of an inherited IRA over a condensed 10-year window.
It stacks directly on top of their peak salary, pushing them into the highest possible tax brackets.
It's almost malicious in its efficiency.
Oh, it's very efficient. The government is successfully extracting maximum revenue at the highest possible rates by forcing the liquidation right during the beneficiary's peak earning years.
And the rules are even more draconian if the beneficiary isn't a living, breathing human being.
Yeah.
Like if the IRA is left to an estate, a charity, or certain types of non-qualifying trusts, they are classified as a non-designated beneficiary.
And for non-designated beneficiaries, the timeline compresses even further to a 5-year rule.
Of 5 years.
Yes, the entire account must be liquidated within 5 years. This has completely upended decades of established estate planning. Because previously, leaving an IRA to a highly structured, protective trust was standard practice for controlling distributions to heirs.
Right, to protect them from themselves.
Exactly. But if that trust doesn't meet the incredibly strict IRS definitions of a see-through trust, the 5-year rule applies, and the trust is forced to absorb the entire taxable balance almost immediately, often at severely compressed trust tax rates, which are much higher than individual rates.
It creates a scenario where the attempt to protect the wealth via a trust actually accelerates its taxation and destruction.
It does. The Secure Act requires a complete audit of any estate plan drafted before 2020. The foundational math of how IRAs interact with trusts and heirs was just rewritten overnight.
We have covered immense, highly technical ground today to synthesize the strategic reality for you, the listener. Required minimum distributions are the inevitable consequence of a decades-long tax deferral strategy. The trigger currently sits at age 73, though the exact math of the distribution requires annual recalculation based on those evolving IRS mortality tables.
And remember, the penalty for non-compliance, a 25% fine on top of standard taxation, is designed to force absolute adherence.
Right. And while the aggregation rule offers significant portfolio management flexibility for multiple IRAs, the system is fundamentally rigid, aggressively stacking forced income onto your ledger and potentially triggering that cascade of higher marginal rates and inflated Medicare costs.
And crucially, the rules governing your lifetime drawdown are entirely divorced from the rules governing the inheritance of that capital. The Secure Act's 10-year rule has engineered a system designed to rapidly liquidate generational tax shelters, requiring aggressive preemptive strategies like those Roth conversions we talked about to protect heirs from massive, concentrated tax burdens.
The overarching takeaway for your own financial ecosystem is the absolute need for proactive, forward-looking taxation strategy. You must audit your account types, recognizing the fundamental difference between pre-tax IRAs and post-tax Roths. You cannot allow age 73 to approach without a multi-year plan for mitigating tax bracket expansion.
You really can't.
And you absolutely must ensure your estate plan aligns with the post-2019 reality so your beneficiaries aren't blindsided by a compressed decade of forced liquidations.
You know, financial planning is often treated as a process of accumulation. We focus so much on getting the money in. But the RMD regulations prove that the distribution phase requires significantly more tactical precision than the accumulation phase ever did.
That is perfectly said. I want to leave you with a concluding thought that speaks to the deeper risk of long-term planning. Throughout this deep dive, we have documented how a single legislative entity can continuously alter the fundamental physics of your portfolio.
They do it all the time.
They move the age from 70 and a half to 72 to 73. They halved the penalty rate from 50% to 25%. They completely eradicated the multi-generational stretch IRA with the stroke of a pen.
Just wiped it out.
We build 40-year retirement models based on current spreadsheets, but the government retains the legal authority to rewrite the underlying code of those spreadsheets at any moment. The true challenge of wealth preservation isn't just navigating the market, it is maintaining the strategic agility to survive a tax code that is in a constant state of legislative mutation. Keep studying the rules, stay agile, and we will catch you on the next deep dive.